Welcome to another video analysing the gold physical market. But what I want to talk about mostly on this channel at the moment is what's going on with gold and interest rates. And when I mention interest rates, I'm effectively talking about the yield on bonds. So when you buy government bonds, what interest payments are you getting on them? And does it mean that as the bond yields go up, that gold prices will go down? And before I get into the actual analysis, I want to make a recommendation. On the Orinem website, there is a map, and this map is effectively showing you every single currency in the world and how it's performed against gold. You can also select silver and you can also select platinum. You can look at any date range. So if you want to know how platinum has performed against an African currency or any of the major or any of the minor currencies that you can think of, this map is an excellent resource, and it's well worth playing with some of the options to see how the metals are performing against other currencies. Okay, so what we are discussing, and as I've already sort of clarified, when I talk about bond yields, I'm talking about the interest payment as a percentage. And this is something that is mentioned a lot in the financial news. We talk about bond yields. Why bond yields are so important to gold is that gold bullion, under normal circumstances, I mean, you can talk about leasing where you can get a return on gold bullion by leasing, but most individuals do not get a yield on their bullion. It just sits there, there's no interest payments on it. This isn't so much of a problem, but as interest rates go up and you could get higher returns through investing in bonds, there is an opportunity cost where you could be losing out by having so much money in gold and silver, platinum bullion, rather than investing in an asset that's actually going to pay you an interest payment. So you can see why, if bond yields go up, and bonds are effectively the risk-free interest payment. So when bond yields are low, there's not much of an opportunity cost by holding bullion. If bond yields go 10-15%, you might think, well, why am I holding gold bullion when I could be getting a guaranteed 10-15%? And that's why the bond market is so important. With rising yields, especially with something like US Treasury bonds, if interest rates keep going up, that normally strengthens the dollar, because what you see is that a lot of international capital that's there to be invested, it will flood into the US. And to buy US bonds, you obviously do that in US dollars. So you would have to sell your Chinese yuan or your Japanese yen or your euros or your Great British pounds to buy dollars, to buy bonds. So that's why when the interest rates go up on US government bonds, it normally boosts the dollar as well, which is a kind of another reason why it's a headwind for gold bullion. When you talk about the relationship between the US dollar and gold, normally it's hard to deny it, especially looking at this chart. It's hard to deny that it's an inverse relationship. And what we mean by that is that as one goes up, the other goes down. Almost like a seesaw. As one side goes up, the other goes down. And you can see here the gold chart, and this goes back to the 1970s. The gold chart is in yellow and the US dollar is in black. Most of the time, and especially the best example is at the front end of this chart. You can see as the US dollar is declining, the gold price is going up. But it's not true to say that if one goes up, the other must go down. If we look here, since 2014, the US dollar has been in an uptrend and gold has been in an uptrend as well. The reason why the US dollar can go up the same time as the gold price is because when we talk about whether the US dollar's gone up or not, and strictly speaking, we're talking about the US dollar index. So when you hear on the news the US dollar's gone up, it normally means it's gone up against a basket of other currencies. So what could happen, and this could well be the case, and I think it is the case on this chart where you're seeing dollar go up, gold go up. The dollar is probably falling, but what's happening is other currencies in this basket, such as the Japanese yen, the euro, the pound, the Aussie dollar, they are going down, but they're going down quicker than the US dollar. So even though the dollar's falling, if other currencies are going down quicker, then when you actually look at the US dollar index, it is actually going up. Does that make sense? So I think that this is why you can have a scenario where gold goes up and the US dollar goes up at the same time. It's all kind of to do with capital flows as well, because if you've got a lot of international currency going into gold, but also going into the dollar, then of course, when you compare those two assets against other currencies that are being sold to buy those assets, they are going to go up because of the capital flow into those markets. I want to look at the overall macro view then of gold and bond yields. And to be clear, the bond yields that you're seeing here are the US 10-year Treasury benchmark yields. So you're effectively seeing the interest payments on the 10-year bonds. And that's in black. You can see that has been in a very, very prolonged downtrend because the bond market's been going up, which means the yields are going down. Whilst the yields have been going down, gold has been going up. So this is quite a clear inverse relationship. I actually done a correlation coefficient test on the whole data that you're seeing on the screen, and it was negative. So there is an inverse relationship. However, you can actually identify certain segments of this. If you break it down, you can cherry pick certain time periods where treasury bond yields go up at the same time as gold bullion. And there was a brief period going into the 1980s where you can see here US 10-year bond yields were going up the same time gold was. 2003 to 2009, not such a clear pattern, but you can see that at the beginning of this chart, you could see that the bond yields went up quite aggressively, and then they sort of like flirted around in a very gentle uptrend. At the same time, gold bullion prices were going up too. And you can also see around 2020 that the bond yields crashed, then they made a recovery. As they were recovering, gold prices were doing quite well. You can also see sometimes where the bond yields were falling. Gold didn't particularly have an inverse relationship response to that. So it's not necessarily true to say that bond yields, if bond yields go up, then gold bullion will go down. But it is a very good predictor. I mean, I've cherry picked these charts to show you that it's not always the case that if one goes up, then the other must go down. But if you look as a rule of thumb, that is true. And I think that part of this is because of the fact that, as I mentioned at the beginning, as interest rates go up, the opportunity cost of holding gold bullion increases because you are foregoing more and more interest the higher these interest rates go. But another thing is to do with sort of muscle memory. People see that bond yields are going up, or they anticipate, because based on technical analysis maybe, they think that interest rates are going to go up on treasury bond yields. So they know from the past that if yields go up, then gold goes down. So they sell the gold. So you can have a lot of speculators that think I'm bullish yields on bonds, therefore I'm bearish gold, let's short gold. So I think that it's kind of muscle memory where, and there's algorithm trading platforms as well where you will get rising yields, rising US dollars, which will immediately result in a short position on gold. Thank you for your attention. Please do watch other videos on my channel. I do a lot of in-depth analysis, and also please like, comment, subscribe to the channel. The more views I get, the more videos I'm going to make. So with your support, we can get quite a busy channel and a lot of information over to you guys to help with your investing.